But in order for inflation to come back down, prices have to come back down. And once we finally see prices start coming down, that's when things are going to get back to normal. The feds are trying to make you go broke. Man, this story really grinds my gears because it is extremely, extremely true. The Fed is legitimately trying to make you go. I'm trying to avoid these ads here as well. The Fed is legitimately trying to make you go broke. It sucks, but it is the truth, and that's exactly what they're trying to do by raising rates. Now, what do I mean by this, right? By raising rates, they're making everything more expensive. And if you look around, everything's already more expensive. But in order for inflation to come back down, prices have to come back down. So if you're looking at the home value in real estate market, right? Home values have gone up tremendously since COVID. Let's say home values have doubled. Now, interest has some places tripled. So people who could afford a $200,000 home, they can't afford a $400,000 home. And in fact, if you throw into that the fact that now interest has gone up triple, they definitely can't afford a home. I was talking to somebody last night. I was telling them as we were walking the neighborhood for Halloween, I said, I couldn't even move into the house that I own today. I could not. The mortgage today on my house would be like $8,000 a month. I don't know how anybody could afford an $8,000 a month mortgage. And the way that raising rates works is that now I can't sell to people because there's so few people who can afford an $8,000 a month mortgage that I have to lower my price. So when I lower my price, let's say it went from $400,000 to $300,000. Now more people can afford it. I can't change the interest rates. I can only change the price of my house. So that is what we've been waiting on, right? We've been seeing interest rates going up and up and up, but we haven't seen prices start coming down and down and down. And once we finally see prices start coming down, that's when things are going to get back to normal. But at what time is that going to happen? How much is that going to hurt when it does happen, right? Because it's not going to come down for free. Prices aren't going to come down for free. Think of it this way, right? If the chicken plant was manufacturing chicken for $3 a pound in 2019, and in 2023 it's now $8 a pound, they've built their entire structure at $8 a pound. Now let's say it goes and they're only able to sell for $6 and then $5 and then maybe $3.50 a pound. They can't afford to pay their employees anymore. So they're going to have to start laying off employees. And the fact that they're trying to raise minimum wage everywhere out there, the fact that UAW workers are a perfect example of this, workers are striking for higher wages, the company literally doesn't make enough income to pay for those higher wages once the prices start coming back down. And that is going to lead to higher unemployment, which is what the Fed ultimately wants. The Fed's fight against inflation is weighing on middle-class Americans. They're growing more and more worried about high interest rates. This is a huge cycle here, right? We've had low interest rates for so long that we all got used to it. Now, as rates are higher, there's going to come a reckoning. I don't want to see that happen. But companies are going to start doing that once they have to lower their prices to catch consumers, to be able to sell to consumers. Once they start lowering their prices, it's going to result in higher inflation. Or, I'm sorry, not higher inflation, higher unemployment. Because they can't pay their employees what they were. So we've got some huge problems out there. The Fed is literally trying to make you broke. Americans are more worried than ever, more worried about the state of the U.S. economy than they were a year ago, despite the resilient job market, slowing inflation, and unexpected surge in growth during the third quarter. The spike in pessimism largely stems from fears about the Federal Reserve's aggressive interest rate hike campaign. It's pushed borrowing costs higher to the highest level since 2001. 57% of middle-class Americans think higher interest rates are having a negative impact on their household finances. 44% said they were stressed about the economy. And that's up from 40% from a year ago and 39% since March. The Fed's meeting again this week, and it's unlikely that they're going to raise rates again, at least right now. They are going to meet 2 more times this year, and there's always a chance that they're going to raise rates even more. Let's see here. Hiking interest rates tends to create higher rates on consumers and business loans, which slows the economy by forcing employers to cut back on spending. Where does the spending get cut back? The biggest expense on every single company is labor, period. Absolutely, no matter what. Hey, my name is Christopher Uhl, and if you're just tuning in, we cover the biggest headlines of the day and what the AI trading data says about it. So if you're interested in that too, be sure to definitely hit the subscribe button down below. And start trading with AI today. Head to ovtlyr.com to see why outliers win. Speaking of outliers winning, Nick is winning today with his gorillas. Thanks for coming, Nick. And let's see here. The Fed funds rate is not currently what consumers pay, but it does affect the borrowing costs for everybody out there. It's just a fact. It goes for home equity loans, auto loans, and credit cards. Higher rates have helped push the average 30-year mortgage above 8% for the first time in years. Americans who carry a balance from one month to the next and the steady increase in rates over the last 18 months could be costing them hundreds or potentially thousands of dollars each month. The credit card balances are at the highest level ever. And there are people who support Bidenomics who are trying to tell you that that's a good thing. They're trying to say that consumers are happy. They are excited to go out and spend money. You and I, we both know that that's not true. They're hitting highest balances ever because everything costs so much more, because inflation's out of control. And they're just trying to live month to month. What is it going to take? Let me know in the comments what you think. What is it going to take to get to the point where we're back to normal? I mean, the very worst example of inflation I ever have seen in my own life was when I went to Walmart to get milk and cereal. I bought 2 jugs of Fairlife milk and a bag of Fruit Loop cereal. $17. Milk and cereal, $17. I remember when my wife and I first got married, we would go to the grocery store and buy ourselves groceries for the week, and it was $35 for she and I for a week. Now it's $17 just for milk and cereal. You can't tell me that things aren't broken right now. Beyond broken. But let's take a look at what the AI trading data says about the S&P 500. We actually got a buy signal on October 17th. So now might be the time, if you're interested in going long the market, to check it out and see if there is something out there for you today. And in fact, these signal returns have generated a 91.22% return. So if you're interested in getting your hands on these AI trading signals and being one of the first people out there with this data, head to ovtlyr.com to see why outliers win. Now let's take a look and see what the internet says about this, right? Credit card delinquencies are now rising at their fastest pace since 1991. Of course, there's tons of delinquencies out there because people can't pay everything anymore. To put this in perspective, even at the peak of 2008, the rate in delinquencies did not hit 50%. And since 2022, they're up now 60%, right? We're at the highest level since 1991, much, much higher than the 2008 recession. We got a lot of issues here, right? Let's see, still waiting for even 1 quarter of negative to confirm we're in a recession. Dude, all you got to do is walk outside, go to Walmart. You can tell me right now that we're in a recession. We can't afford not to have a severe recession either. That's kind of where my head is at too. When I say I don't know what it's going to take to fix this, I don't know, but I do think that we might need a severe recession to actually fix things. I do remember back in the 2008-2009 timeframe when we were going through the recession, everybody was lowering prices like crazy just to get our customers back. I remember, going to Applebee's or whatever and getting the 2 for $20 deal, right? 2 people could eat with drinks and an appetizer and dessert for $20. Dude, at this point, just the drinks, just for a drink, is $20. The Fed knows the U.S. is going into a recession. That's probably the only way to fight inflation, reducing interest rates at the same time. Why do you think delaying a correction is a good idea? It simply raises the fall even further. Listen, there is a ton that we got to figure out, and I don't know what the answer is. And I also have no idea how the YouTube algorithm works, but it tells me that you're going to love one of these 2 videos, so click here to watch more. Thank you so much for tuning in to today's Outlier Live. We'll see you on the next episode.